Put simply, it's been the fairest recovery on record. We see this in gains not only for middle-class Americans, but also across demographic groups, such as the rapid decline in unemployment rates for Black and Hispanic Americans.
Look, the outlook that I have and that most economists have is a very favorable one. We have an economy that has been growing at a good, healthy pace. I see no reason why that can't continue. I think 2024 is going to be a very good economic year.
And so there was a period in which that was a great concern. Prices for a while increased more than wages. Now, the opposite is true. Wages are now increasing at a faster rate than inflation. People are getting ahead. They're seeing their fortunes improve.
What's she smoke?
All right. Today is Sunday, Jan 28th. This is a recap for the stock market activities this week and an outlook for the week to come. And folks, I got a good one for you tonight. Hope you enjoyed the long and healthy weekend and you watched the football. And I'm sorry about the intro of the video if it got your blood boiling because of Janet Yellen. The bad news is we got more Janet Yellen to talk about. And the problem here, folks, is we have fake economic data that comes out. Of course, it's the election year, the funny season, so lots of cooking of the data and lots of deception. And it appears that the administration is now using this data to go with the Bidenomics election strategy, which I thought and still think that it is a risky strategy. Number one, you risk sounding out of touch with the American public. Number two, what if the economy slips into a recession? And that's the inevitable. It's just a matter of when and how. But rest assured, folks, there is plan B. If the whole Bidenomics strategy doesn't work out, we go to plan B, which is war. Let's begin with the breaking news that we got today. Here it is. The headline reads, 3 U.S. service members killed, 34 wounded in Jordan drone attack linked to Iran. Our first question is, what the hell are we doing in Jordan? Last time I checked, that's not in America. I'd rather have the troops in the border, Chicago, Detroit, Baltimore, LA. But somehow we have thousands and thousands of troops protecting our country, quote unquote, in Korea, in Jordan, in Iraq, in Syria, in Japan, in Thailand, in Tanzania. But in any case, folks, we talked about this before, the geopolitical risk. It is real and it keeps getting hotter and hotter and hotter. And this is why the hedge, it's no longer the VIX or buying puts over the weekend. Rather, it's been the theme of buying oil over a weekend to hedge against the geopolitical risk. And we talked about buying USO. That's probably the best hedge for now. Oil stocks, they have their own fundamentals too in earnings. We're amidst earnings season, so you're better off going with the commodity here. And this is not going to stop. We're probably going to have more escalations from here, so oil prices will go higher. And we talked about the opportunity that we got this week in stocks like Lockheed Martin and Northrop going down after earnings. Those dips will be bought because of the geopolitical risk. But folks, when we talk about oil prices going higher because of the geopolitical risk, isn't that inflationary? And doesn't that go against the whole soft landing / Goldilocks narrative by the Fed? That inflation has been defeated and economic growth is still intact and everybody's gonna live happily ever after. We can't declare victory, folks, before we know for sure that the reinflation risk has been eliminated out of the economy. Not just that, but the recession risk has to be eliminated out of the economy. None of them has been achieved yet, but we're already declaring victory. Of course, the Fed says we're not doing that, but actions speak louder than words. How can we say that inflation has been defeated when we look at global container shipping prices skyrocketing because of the geopolitical risk? When we look at oil tankers, the prices for those fuel tankers are skyrocketing because of the geopolitical risk. All of this is going to impact the consumer sooner than later, and it will show up in the data. You look at oil, the WTI, crossing above the 200 days moving average. Many technical analysts believe that crossing above the 200 days moving average is a bullish signal, meaning that we have more gains to come in the price of oil. Then you look at heating oil, aka diesel. That's what trucks use to transport goods around the country. If you look at the chart, it appears that we have a descending line of resistance, but we're about to defeat that by forming a pattern of higher lows. And if diesel prices go higher, that's going to be inflationary in the economy. You look at the gasoline RBOB, which is a proxy for the prices at the pump. So far, so good. We're not seeing a problem right now. But to go with the Bidenomics strategy without knowing what this chart is going to look like as we head to September, October, November is a really risky strategy here. It appears that we are at a support zone. We're forming a double bottom here, and it appears that gasoline RBOB is about to move higher. And that's going to be good for refiners stocks, by the way. Names like Valero, like Marathon, you've seen them outperforming as of late. And if we see gasoline RBOB moving higher, they will continue to outperform. But that's inflationary, and that's not good for the re-election prospects of Joey B.
Come on, man.
Furthermore, when we talk about, inflation went down and mission accomplished, when we look at leading indicators, you can see the correlation right here. Leading indicators are perking back up higher. And if that is the case, it's just a matter of time before inflation readings also move higher. It's just a matter of time here. So we go back to the elephant in the room, which is, do we have a legitimate reason for the Federal Reserve to begin cutting rates at this point? The answer is absolutely not. The only reason the Federal Reserve will begin cutting rates is a political reason. If Mr. Powell and company at the Fed want to play politics and choose one side over the other, they'll begin cutting rates prematurely in what is known as a preemptive rate cut. Now, we know that Jay Powell, he doesn't like Trump. Trump wanted to fire him. Ironically, Trump is the guy who hired Jerome Powell. But he said if he gets back in power, Jay Powell will get his pink slips. So, of course, Jay Powell has a dog in the fight and he wants Biden to win. Will he go as far as cutting rates for political reasons to save his own ass? Unfortunately for Mr. Powell, if he does that, he could risk re-inflation. As we've seen back in 07, 08, into the summer of 08, when we've seen oil prices surging higher because of the Fed rate cuts. So there's a lot of risk here. But fortunately for us, we have a Fed decision coming out next week and the commentary that comes with it. And that's going to shed a lot of light about the March most anticipated meeting here and the FOMC decision, because we have that 50-50 that the Fed will cut rates or keep it as it is in the March meeting. But let's begin with the talk of the street this week, which is the GDP reading. And of course, the administration took a victory lap. The Federal Reserve took a victory lap. Janet Yellen took a victory lap because of this reading. And the headline reads, U.S. GDP grew 3.3% last quarter, capping an expectedly strong year. Here are the details. The U.S. economy surged ahead at a greater than expected 3.5% annual growth rate in the fourth quarter, as lower energy prices freed consumer spending, the Commerce Department said. The preliminary estimate of the economy's growth came amid a rush of data that showed a mixed picture of the U.S. economy. Construction spending unexpectedly fell 0.4% in December, the Commerce Department said, led by a ninth straight drop in residential buildings. Also, business activities in the Midwest contracted in January, confounding expectations for continued expansion. Still, a survey by ADP Employer Services showed that private employers likely added 152,000 new jobs in January, and a separate report showed a moderation of employment costs and an increase in application from home mortgages as both home purchases and refinancing picked up. I'm sorry, folks. I made a mistake here. I made a huge mistake. I apologize. This is the reading from the fourth quarter GDP in the year 2007. Fourth quarter GDP surged 3.5% stronger than expected. What's wrong with that? Why are we going back to 2007? Because shortly thereafter came the actual reading of Q4 2007 GDP. And here's the headline. GDP fell in Q4 2007, the first drop since 2001. Whoops. The U.S. economy shrank during the closing months of 2007 for the first time in 6 years, the Commerce Department confirmed on Thursday, hurt by the steepest slump in housing since 1981. But it bounced back to a record modest growth in 2008, avoiding back-to-back quarters of decline that would have met a popular definition of a recession. Pay attention here, folks. I'm going back in history here to show you something, that you can dismiss recession and say, it's not going to happen, and then it hits you from nowhere. Because we all remember what happened in 2008. Continuing, the department sharply revised its estimate for the fourth quarter performance to show the gross domestic product, or GDP, contracted by 0.2% rather than growing 0.6% as it previously reported.
Oh, no.
Uh-oh. How much you want to bet that they're going to come out, the cooks, of course, they're going to come out and change and revise this GDP reading that we got for the fourth quarter of 23 that everybody's jerking off to. And then, whoops, did we say that the economy expanded? We meant that the economy contracted. Sorry, everybody makes mistakes. I mean, look at what happened with the employment data from 23. The headline reads, initial U.S. employment reports overstated by 439,000 jobs in 2023. How could you overstate jobs by over 400,000 jobs if it's not due to the cooking and the manipulation of data? The lesson here, folks, is take this fake data with a grain of salt and look at what's going on with the consumer in reality, and what's going on in corporate earnings, and the warnings that we keep getting from corporate earnings about slowing consumer demand. And I love this interaction by billionaire bond investor Jeffrey Gundlach on Fox Business. He questioned the unemployment data, saying that it's hard to believe. Take a look.
The thing that I'm most concerned about now economically is reports coming from the states. We look at national unemployment data, and heard in the previous segment talking about that. I thought it was a good conversation. But the states release unemployment data too. And amazingly, 88% of the states, and I think they have DC in there, so there's 51 of them, 88% of them are reporting rising unemployment over the last 6 months. And I'm having a very hard time squaring this circle. If 88% of the states are reporting rising unemployment, how can it be that national unemployment remains stable at a very, very low level?
Right.
I guess the only logic would be that the other 12% of the states are making up for all of that rising unemployment, which is kind of hard to believe because those states, while it includes Texas, and I think includes Pennsylvania, it also includes North Dakota and Wyoming. It's hard for me to believe that this set of states can offset rising unemployment in Florida, Illinois, California, New York. And so I'm skeptical about this data. And so I noticed that in the JOLTS survey, that job openings thing that was getting a lot of play because it was so elevated, the percentage of surveyors responding to the survey used to be 75%. And now it's down, I'm talking about maybe 5 years ago, and now it's down to 35%. So what is going on here?
And folks, even if we assume that the data that we got from the GDP is right, what is the problem with the data? See, the GDP is the most manipulated number in economic history. You can expand the GDP by government spending. You can expand the GDP by debt accumulation. We'll look at the components that contributed to the GDP going higher. Government spending year on year. That's the major contributor. And are we spending money that we have? Of course not. Look at the budget deficit. Look at the issuance of bonds, the tsunami that's about to resume in the month of February to finance all of this spending by the government. Non-residential investment, that's actually down year on year. If we look at consumer spending on goods, it made a major comeback. Now, you could say, oh my God, look at that, Maverick. The consumer is healthy. They're spending back on goods. Be careful what you wish for here. The majority of decline in inflation came from goods deflation. If the consumer is now spending back on goods, watch out. We will see reinflation in goods, and that's going to be bad for the Fed for any rate cut expectations. Spending on services remains the same year on year, exports down, residential investments flat, imports down. So again, when propaganda minister Janet Yellen comes out and says this strong U.S. GDP growth signals productivity gains in the not inflation, or when she says that Americans are seeing inflation well under control. It's bullshit. The spending on goods will bring back inflation. We talked about the geopolitical risk. Container shipping rates going higher. Diesel prices are going higher. Soon enough, gasoline prices are going higher. And that's going to increase goods inflation in the economy again. And oh, by the way, all of this spending by the consumer, you know, the healthy and strong and resilient consumer. And you guys are looking around and saying, well, what the hell are they talking about here? Where is that coming from, really? How about debt? Credit card spending. Swiping those credit cards up and down, up and down, up and down. Because, you know, you're never going to lose your job. You just spend right now. You'll pay it later. Buy now, pay later, or never. You know, the Biden administration will forgive your debt. That's what the consumer thinks right now. If I go bust, who the hell cares? The bank will go bust. So we see credit card spending volume in all major banks going higher, exceeding the rate from 2019. When you look at delinquency rates, 30 days plus for every major bank, this rate is now exceeding the rates from pre-pandemic. How could you say that the economy is healthy and resilient and all that bullshit when it's fueled by government spending and debt accumulation by the consumer? And this is why Wells Fargo came out this week with a major warning that the American consumer won't save the economy in 24. And their wild holiday spending spree was the last hurrah, quote unquote. Well, gee, why would they say that? Here it is. Consumers are propping up the U.S. economy, but they're going into debt to do so. What are they talking about? Here it is. Consumer spending, which accounts for about 2/3 of GDP, was a major component of the surprisingly strong reading. It rose 2.8% for the period, down just slightly from the previous quarter. However, the report also showed that households were drawing down their cash reserves. Personal savings fell from $851.2 billion in the third quarter to $818.9 billion at the end of the year, while the personal saving rate, which measures personal saving as a percentage of disposable income, dropped to 4%. So when Yellen comes out, propaganda minister, and she gaslights all of us, and she says Bidenomics is working for the middle class, what the hell is she smoking here? We have to accumulate debt to spend in the economy. And when you look behind the facade, the reason why the economy is growing is because government spending. You peel the onion even more, where is that government spending coming from? Debt accumulation, issuance of bonds, deficit in the budget. This is not a healthy economy, folks. This is an economy and a consumer, as Wells Fargo suggested, on their last leg here. And we know, historically speaking, that a recession could storm out of nowhere. We got the indicators. We got all the warnings. Didn't happen in 23. Now folks are feeling cocky. That's never going to happen. And that's when it hits. And this is why, folks, we have a huge disparity here between how the administration and the media feels and the economic numbers, CNBC, the propagandists, of course, the talking heads. They talk about the economy as, oh, it's the best economy ever. But then you go down the street and you ask the voter, what do you feel about the economy? And they did that in New Hampshire because we had a primary. Here's the headline. CBS anchor admits he could not find a single person outside of New Hampshire grocery store who feels good about the economy. Well, gee, why is that happening? We're living paycheck to paycheck. We're using credit cards. The moment we lose our income, goodbye. And this is why renowned economist Mohamed El-Arian, who's now waking up to his senses again, he says 3 reasons the U.S. economy's strength right now is a head fake. Reason number 1. Recession risk is still elevated. Reason number 2, reinflation risk is still here. Reason number 3, the geopolitical risk. Look at what's going on in the actual economy. Folks are losing their jobs. We got news recently from eBay, from Wayfair, and this week we got Microsoft laying off 1,900 employees. We got Paramount also laying off thousands of employees. LA Times slashing about 20% of the staff. And it's just not in the media or technology, folks. It's happening in the micro level. It's happening in mid-sized businesses, small businesses. You see it all around you, that somebody lost their job. And these are the early warning signs that the economy is not really that healthy. So again, when you see the articles such as this one here, it's really unbelievable how out of touch the media and the elite are from actual living Americans in the economy. Headline reads, Bidenomics is working. It's too bad for Biden that Trump's message of doom is winning. It's not about that. It's about reality in the economy, not the fugazi numbers that you guys keep revising once you're done using them. And even regime propagandist from Yahoo Finance, Rick Newman. He kind of surprised me with this article right here. This week in Bidenomics, the inflation election begins. And listen to this. Rick ends the article by saying that, hey, the confidence index from the University of Michigan survey indicates that Americans are beginning to believe that inflation is really abating. Biden and his re-election team feels emboldened and reportedly plan to make the case for the next 10 months the Biden economy is helping more people than the Trump economy did. But listen to this. This is a really important piece from the article. Rick says, the gamble is that voters won't feel it, which would make Biden look like he's out of touch. If he is, Trump will probably be the next president. Bingo, bingo. And I would add to that, it's not just the out of touch part. It's what if the recession actually happens? You can't dismiss that. What if reinflation actually happens? The duality of the risk. So again, the Bidenomics strategy is a really risky strategy. Either the economy holds and the stock market holds, then okay, high risk, high reward. But boy, if anything goes wrong here, and even this added touch part of the Bidenomics strategy, if that lands, that's going to be a big problem. And then comes November and he's back. And now we have to talk about the orange man again. But folks, this concludes our macro segment of this show. Let's go to the market segment here. What do we do with the stock market right here? The divergences keep going on, not just between the stock and bond markets as we discussed in details in the last weekend video. You look at the divergence between the SPX, as you can see in white, and the IWM small caps, which any economic recovery should begin with small caps. But you see the lag here. You see the divergence. SPX is trading higher, small caps not really following, never really recovered from the drop since 2021. Another important indicator is the XLY versus the XLP. XLY is consumer discretionary. XLP is consumer defensives. So when you see this chart going higher, we see that consumer discretionary is outperforming consumer defensive. And that's how we know that we are in an expansion period of the economy, not a contraction or a defensive phase of the economy. Well, all of a sudden right now, if you look at the last bit of candles there, weekly candles, we're trending down. It means that defensives are outperforming consumer discretionaries and consumer cyclicals. That's not a sign of an economy under expansion. That is a sign of an economy under contraction. And then you plug in the SPX, again, the S&P 500. You can see the correlation, it's clear. But we have a divergence as of late. SPX, the S&P 500, flying high, but the leading economic indicator is pointing to the downside. What's up with that? We talked about how the SPX and the Qs for that matter, the NASDAQ, are not really good representatives of the stock market anymore. And that's stunning to say. But the S&P 500 is not your father's S&P 500 anymore. 10 stocks form over 30% of the weighting in the S&P 500. 10 stocks, the big technology stocks. But this bit of the divergence and the rally in the S&P and the NASDAQ did not really come from the big cap, aka the Mag 7 stocks. They came from semiconductor stocks, aka chips. So if you look at the Mag 7 ETF, MAGS in green, and then you look at the SMH, this is the semiconductor ETF in orange, you can see that the Mag 7s are doing okay. I mean, they're up 6.5% for the year so far, mostly because of Meta and Google, a little bit of Microsoft in there. But then you look at the SMH, up almost 11.5% for the year so far. And when you dig down in the components of the SMH, it's really NVIDIA and AMD, two stocks that are holding the entirety of the stock market right now. And why do we see this divergence? Here's the headline that we got over the weekend. The U.S. will announce major chip grants by the end of March, paving the way to send billions of dollars to semiconductor makers in a bid to supercharge domestic production. In other words, government spending again. We're giving handouts, welfare, to some of the richest companies in the world, trading at all-time highs, making record profits, like NVIDIA and soon enough AMD. And Intel, that's what's keeping the stock market going higher. That's what's keeping the economy afloat for now. Look, we can agree. I actually agree. I don't disagree. I think we need to produce chips in this country here for national security reasons. But I don't think in a free market economy that we should subsidize that. When you have all of these companies making record profits, they should dig into their own pockets to build the factories, and then we'll give them some tax breaks after that, depending on how many jobs they create. Another reason is the geopolitical risk. We know that we're going to ban countries like Russia, China, Iran from buying these really advanced AI chips. Well, guess what? The Russians, the Chinese, Iranians, and others using proxies and fake companies to buy chips from NVIDIA, Intel, AMD, worth billions and billions of dollars. And that's also fluffing up these companies. And we see the massive divergence, the have and have-nots, not just in the economy, but the stock market too. When you look at the S&P 500 versus the technology sector right now is outperforming the S&P 500 by the most in history, even more than the dot-com bubble. The risk with all of this is, if it is indeed a bubble that lasts until the AI mania subsides and the spending by the government has to come back into rationale because of the election season, then the bubble goes bust, and then who do we have to hold the stock market here? That's the risk with bubbles. Things go out of control, in a good way, if you happen to be an investor in the stock market. But then when they come down, when these tailwinds become headwinds, they drag the entirety of the market down with them and the entirety of the economy down with them. That's the risk here. And folks, we got a busy earnings season here. And the problem is this is the make or break moment for these companies. And so far from the earnings that we got Texas, we got Intel. Both of them are not good. The guidance came out weak. You saw Texas down, you saw Intel crashing on Friday's session, down over 11% in one day. And we've seen other companies that also held the stock market and retail investors' enthusiasm in the year 23, such as Tesla, falling apart. And Tesla's going to have a major problem right now because they lost margins. So Tesla is out of the Mag 7. We said that repeatedly last year, that Tesla should not be in the Mag 7. They have a major problem. It's not really a B2B business like Microsoft. It's a consumer business like Apple, which is the next casualty, by the way. But when you look at leasing for EVs in dealerships, that's recovering. That's moving higher. Then you contrast that with the leasing shares of new Teslas globally, that's trending down. So it's not only that Tesla losing margins, but they're also losing market share globally. So one of the most important stocks in the market has now lost a major tailwind, and now it becomes a drag. So this is what we have to watch for. The fall of the stock market comes component by component. And right now, we only have the Mag 7. We lost Tesla. Well, soon enough, we're going to lose Apple. Okay, then we have the Mag 5, I guess. What if we lose Amazon because the consumer gets weaker? And then we have Meta, Google, and Microsoft. And then you have NVIDIA and the semiconductor companies, maybe AMD. Then what? We have, again, 5 to 6 stocks holding the entirety of the economy in the stock market. And next week, we have a busy week ahead of us, folks. Monday, we have SoFi. Then we have Whirlpool. This is really important when we talk about good spending by the consumer in the fourth quarter. Tuesday, we have Pfizer, GM, UPS, Microsoft, here it is. And UPS is an important indicator for the health of the economy, by the way, so that's going to be another important one. But of course, all eyes on AMD. Now, I'm on the camp that if AMD just takes away 10% of the business that NVIDIA is about to generate, then the valuation for AMD will be cheap. So I still see AMD, depending on the guidance, it could still hold here. But if they come out with a weak guidance, then forget about it. Then we got Alphabet. That's another important one. Starbucks. Wednesday, we have Boeing, Qualcomm, MasterCard. Thursday, we have Merck, and then Meta. In my opinion, Meta will be the most important one because in 23, the stock recovered because of the recovery of margins. And the reason is Zucchiniberg and company managed to cut costs, but now they're spending more on the AI chips. They're resuming spending on the metaverse, so we could see the margins contracting here. And of course, the big kahuna, Apple, most important company in the world, $3 trillion, worth more than the entirety of the Chinese stock market, which is insane. So it's going to be put to the test here. Friday, we have Exxon, Chevron, the oil giants. Then we have important names in the healthcare sector. You know, we're talking about healthcare as perhaps the sexiest sector of the stock market this year. So we have important names here in AbbVie, Regeneron, and Cigna. Now, besides earnings, you got to be aware of another important event that will take place in the stock market this week, which is the CTA's commodity traders will sell under any scenario. So they're going to sell billions and billions of dollars worth of stocks. Goldman says momentum traders to sell stocks in every scenario. What are they talking about here? No matter which way markets go, Goldman Sachs Group says some traders are modeled to sell stocks over the next week. Cullen Morgan, an equity derivatives and flows specialist at the bank, expects that commodity trading advisors, or CTAs, that surf the momentum of asset prices through long and short bets in the futures market could be forced to sell after building $129 billion in long positions. Listen to this. The trend-following cohort are modeled to sell $10 billion in a rising market and up to $42 billion if stocks decline over the next week. On a longer time frame of 1 month, CTAs are likely to buy $42 billion in rising markets versus $226 billion to sell should markets start to trend lower again. And why are the CTAs dumping next week, regardless of what happens? Well, they're overpositioned on one side, so they're mostly on the long side right now to excess. If you look at this chart right here, they dumped in July of last year. They dumped before the bear market in 22. They dumped before the crash in 2020. So their timing is pretty good. If they're going to dump right now, you got to pay attention to that. Now, CTAs are only one participants in the market, and they usually trade the futures. So we're going to see an impact. But again, they're not the only player here. We could see other events because of earnings, because of the Fed commentary, because of the jobs report we're about to get on Friday that could change the direction of the market here. But keep in mind that the CTAs are dumping. And the CTAs have no dog in the fight. They follow the momentum. So if you just follow the CTAs, you've probably done pretty good in the stock market so far. And right now, they're going to sell under any scenario next week. And if the market goes down further, they sell more, which also enhances the chances of inverse gamma squeezes and phenomena such as volume-geddon, where we see massive selling all of a sudden. So you have to keep an eye next week on the flows. If you see big sell orders, then probably the CTAs will sell more, and that's going to create a negative cycle of feedback. Maybe the market maker will join and dump too. But for now, we know that at least one player in the market, CTAs, will dump under any scenario. So what do we do here in the strategy? Look, the weekly strategy for last week, it worked out pretty good. Only one play that did not work out. And again, it's kind of hard to have all of them playing out because we have directional plays here. Some bearish, some bullish. So the bearish exposure was to buy some puts in the Qs. That did not work out because the Qs went higher. But our bullish plays playing out pretty good. And the majority of traders that I have in Discord made a lot of money from these trades. And then the trades that we spit out for the USO and Apple and AMD after that. But if we look at the dollar hedges that we got for the week, calls in the GDX and the FXI, if you look at the chart of the GDX, since the closing of last Friday, we have seen a pump of about 5% or so. And again, most traders, these are weekly trades, so once you get a pop, you're selling right away. Most traders made money from the trade. FXI, the Chinese ETF, also got a nice pump. It went down initially on Monday, but then since the close from Friday, it went higher by about 6.5%. So we got a check mark on that. On the bond hedges, we got trades for names like the IWM small caps, riskier bets like LAZR, SoFi, Unity Software, U-Haul, TLT, anything in the light at the end of the tunnel portfolio. If we look at those, for example, IWM for the week, since the close from last Friday and the high of the week, the IWM traded higher by about 3.25%. If you look at LAZR, since Friday's closing also, this one traded higher by about 32% or so to the highs and then went down later on. And the same thing, SoFi popped higher since last Friday by about 11.5%, then it went down. But most traders got out at the initial pop here. And then we have Unity Software, same thing. Friday's closing, we got higher by about 7%. And a lot of traders got out and booked the profits right away. And then, of course, Unity went down, closing flattish for the week. U-Haul did not work out as good as the rest, but also traded higher since the closing of Friday by about 2%. And then it took a retreat. So we got a check mark on that. Most traders got out at the top, made a quick buck here in these trades. Then we got oversold EV plays in Revvion and Lucid. If you look at the Revvion trade, a lot of folks made about 100 to 120% worth of gains because Revvion initially went higher by about 8.5%, then it went down, closing negative for the week. If you look at Lucid, it's the same thing. We got an initial pop here of about 16 to 17%, and then it went down, closing negative for the week. But you can't be too greedy here for a weekly trade. You make a quick buck, you book it, goodbye. In, out, hello, goodbye. So we got a check mark on this one, but now what do we do for the week that's about to come here? If you are in my Discord, we talked about being long USO and then betting for a rebound in Tesla by buying calls on the TSLL because the calls are cheaper than TSLA. We're just betting for a rebound, that's it. The short trades, we have a trade against Apple that has been working out, and then we have a trade against AMD again. We'll see if that's going to work out Monday, Tuesday, but we're probably going to close all of these trades by Tuesday max, because once we head into the depth of earnings season, your exposure has to be as neutral as you can. We're going to play those earnings plays, at least for the major ones, in neutral plays, meaning that we bet on the implied volatility in both directions. If there is a move that exceeds the implied volatility, then we get rewarded for it. But of course, the week will be not just because of earnings. We will also have the CTAs dumping. We have the Fed decision for January and the commentary for March. We have the jobs report. We have a lot of events happening here. Not to mention, of course, the development in geopolitics and the retaliation by the United States against the attack that we got just over the weekend here. So we're probably going to neutralize the exposure Monday, Tuesday by the most. Say if we get a pop in Tesla, a rebound, or a continuing of the drop in Apple or AMD, we'll book those, and then we'll have another strategy for earnings and take it from there. Anyhow, folks, let's add more color to this conversation by covering the markets details. And we begin with the closing of the indices last Friday, and here we go. The diamonds in the green by 60.30 points, or a gain of 0.16%. The Nasdaq in the red, down by 55.13 points, or a loss of 0.36%. The spider neutral here, flattish, beat in the red by 3.19 points, or a loss of 0.07%. The same can be said for the Russell 2000 small caps, flattish, beat positive by 0.01 point, or a gain of 0.01%. We look at these sectors on Friday again. Energy on top, the geopolitics, the breakout above the 200 days moving average. All of these are good things for energy right now. And it was a defensive theme all in all, because in number 2 you got defensives, number 3 you got healthcare. The laggards, once again, technology, the risk on, and real estate, which is also risk on when it comes to bond yields. Now, if we contrast the daily performances on Friday versus the weeklies, we see a different picture here. The majority of the market was positive, but again, led by energy. Then we have comm services. Thank you, Meta. Thank you, Netflix. Thank you, Google, the big names. Financials also managed to outperform the banks, regional banks, big banks mostly, and technology did pretty good. But the laggards, cyclicals, thank you Tesla, the underperformance by the souffle. Then we have real estate remains weak. That's the riskiest part of the economy right now. If we look at the breadth on Friday, neutral, mission accomplished by the market maker, NYSE, 58% advancing versus 40% declining, so a little positive in the NYSE. But the NASDAQ slightly negative here, but really neutral, 48% advancing versus 48% declining. So a neutral close in preparation of the lengthful slew of action from earnings, from the news, from the macro data we're about to get. So buckle up, folks, here. We have a really interesting week to come. Let's move on to commodities on Friday and see how they performed. And we see that energy, again, gaining on Friday. Up day for the WTI and Brent. Brent gained over 1.5%. The RBOB and Nat gas were neutral, flattish, but you got diesel, heating oil up by about 4% on Friday alone. Are you paying attention, Janet Yellen? Are you paying attention, Mr. Powell, or not? And then you have softs. Cocoa, OJ, coffee. They remain the hotter trades in softs. Did not disappoint on Friday. Massive gains for coffee and OJ specifically. Then we have modest drops in cotton, down about 1.5%. Sugar down about less than 1%. Metals all over the place. Neutral reactions by defensive metals such as gold and silver. And then we have the risk-on metals, platinum and palladium, outperforming, but copper is out of the picture here. So mixed messages. Meats up across the board, led again by lead hogs, while grains down, led by soybean meal futures, down about 2.5%. If we look at the weekly performances all in all, we see that heating oil, again, diesel, the winner of the week, up about 9.5%. That's going to show up, folks, in the transportation cost, in goods inflation, so buckle up here. We see lean hogs also gaining about 7%, the WTI gaining a little over 6.5%, and the same goes for Brent. So we see the risk of reinflation being illustrated right here. Moving on to the big casino, the options market. What do we see here? The volume is slightly up on Friday. We got options expiration, so there is no surprise here. But you got to pay attention to the details. We know that the majority of flow has been for the call side, aka the bullish side, for the chip names such as NVIDIA and AMD. But we've seen a shift. A little bit of a shift here, where folks are beginning to buy some puts on NVIDIA and AMD. And now we have also Johnny-come-latelys buying puts on Tesla. So what is the message here? I want you to look at the IV rank. What the IV rank says is, where's the implied volatility relative to the lows and the highs going back a year? So in Tesla, for example, the implied volatility right now at 21%, relative to the low and the high going back a year. In AMD, it's 99%, so it is at the high of the range going back a year. Now, you can't just use the IV rank to make decisions, so you can use the IV rank and something we call the IV percentage. So you look at Tesla, IV rank about 21%, but the IV percentage is 2%. What does that mean? Going back a year, in a year time frame, looking at the implied volatility, only 2% of days we've seen the implied volatility lower than where it is right now in Tesla. In other words, we've maybe reached the bottom of implied volatility here. In other words, the stock dropped too much. We only have now 2% of days going back a year showing less implied volatility than we have right now, which basically tells us that the implied volatility is probably too low for Tesla, which means that we have a change of direction coming. Now, if you look at AMD, we see 99% of days going back a year where we see the implied volatility lower than where it is trading right now, meaning that the implied volatility for AMD is way too high, which also indicative that we're about to see a change of direction here. What is the point? The point is the IV rank is pretty good in showing you where the implied volatility looking at right now relative to the peaks and valleys going back a year. But the IV percentage, when you see huge abnormal readings here, way low, 1%, 2%, or way high at 99%, you're probably going to see a change of direction here. Specifically when you have not just the IV percentage, but the IV rank and percentage trading way too low or way too high. Just keep it simple here. If you didn't understand the explanation that I just gave, keep it simple here. Abnormal readings, way too high or way too low, are probably indicative of a change in direction coming. Let's do the unusual activities that took place in the options market on Friday and see what we have here. We begin with a butterfly put spread for the SPY. Now, I see a common mistake here where a lot of you buy naked puts way out of the money, let's say for May or September of this year, betting for a stock market crash. That's really a fool's errand. If you're betting for a crash using put options, you're better off using a butterfly strategy where you spend very little money, but you also get decent exposure if we have major downside. And the idea of a butterfly put spread is you buy a put out of the money, then you buy a put below with 2-to-1 when it comes to the volume. So if you bought one put at price X, you're selling 2-to-1 at price Y, which is below price X. But now you have a deficit. How do you cover that? You buy one put 1-to-1 to the one that you bought, the X, let's call it Z, which is below price Y. And therefore you have two puts at price X and price Z. And then you have 2-to-1 puts that you sold at price Y, which is between X and Z. In this case, price X is the 440 put, which the trader bought. And then they sold 2-to-1. You see the volume here, 2-to-1 almost, at the 425. That's price Y. That's the body of the butterfly. But now they have a deficit. They sold more than what they bought. So they have to buy price Z, which is 410. This is going to give you exposure to the SPY if it goes down below 440 all the way to 425. That's the price point when your profits begin to trim and stop. So basically the bet is SPY goes down by about 10%, but not more than 13% by the expiration date of March 8th. You can see if you do the math here, paid about 65 cents a piece for the 440. Then they paid about 35 cents for the 410. That's $1. But they received in credit 45 cents a piece. But a reminder, they sold 2-to-1, the 425. So they received what? 90 cents a piece from selling the 425 2-to-1. All in all, the entire investment in such a bet is about 10 cents a piece. So really cheap exposure if we have a major downside coming in the equities market. And then we have GOOGL. This is Google, and we have Alphabet earnings coming out this week. So somebody's betting for a pop coming. And they bought the 162.5 calls for the expiration date, February 9th. The expectations, Alphabet will pop higher by more than 7% by then. Paid about $1.20 a piece, tenor. This trade, all in all, spending about $3.3 million. Then we look at the ticker COIN Coinbase. It's been getting hammered because of the sell the news event after the ETF realization, the Bitcoin ETF realization by BlackRock and all of that. So we see sell the news here, but somebody says maybe we're going to see a rebound coming for Coinbase. They bought the 134 calls for the expiration date, February 2nd, meaning this Friday, betting that Coinbase will recover by more than 7% by then. Paid about $1.70 a piece, tenor. This trade, all in all, spending about $2.1 million. If we move on to the heat map for Friday, what do we see here? We see de-risking in the big caps, not all of them. Apple, Microsoft, and then the chips went down on Friday's session. Not all of them. Taiwan still positive, but NVIDIA, Intel, Broadcom, AMD, even the manufacturers, AMAT, Lam, all down. And the reason is we got bad earnings from, or guidance, I should say, from Intel and WDC, Western Digital. So a wake-up call for the euphoria that we see in chips. Now it comes down on the lap of AMD. Is it going to confirm that, yeah, we're getting ahead of ourselves here when it comes to all of these assumptions about chips? Or will AMD give us a blockbuster guidance and resume the mania in these names? And then, of course, Friday, we see healthcare, some rebounds in the health insurance, such as United Health, which, again, we suggested that you buy the dip after we saw Humana going down, and UNH managed to rebound pretty good. Some of the banks, specifically in financials, AXP, Amex, delivered good earnings, so we see the name up about 7%. But Visa, the day before, showed a slowdown in the growth of volume and transactions, so we see Visa down about 2% on Friday. The energy sector took the leadership here, and we see, of course, defensives taking leadership again. It was a defensive posture on Friday, but also notable that we see Nike up about 2% on Friday. Since throughout the week we talked about China stimulus, so we see some traders here saying, okay, if we have China stimulus, it's not just going to be good for Alibaba and Pinduoduo. It should also be good for Nike and Starbucks and a lot of US-based companies with a lot of China exposure. I think this assumption is premature, but again, Nike went down big after the last report, so we see some short covering here based on that news. If we contrast the theme with the weekly theme, what do we see here? It's all about earnings. Of course, we have certain themes that were predominant, such as energy. You see ExxonMobil up about 6.25%. Chips were outperformers for the majority of the week until, of course, we got Intel and Texas. But then it's really about earnings. So you see the contrast in industrials. You see the defense contractors down, Lockheed, Northrop, but Raytheon up. And then you see Caterpillar up. You see the contrast in defensive. positives, Procter & Gamble up, but a lot of other names are down. The same goes in cyclicals, the same in comm services, the same in banks. PayPal down, although PayPal did not report earnings. It was just a sell the news event. But then we see Capital One and American Express moving higher. So it's all about earnings here, so we cannot really look at the map and extract a theme. If there is a theme besides energy and the big caps and semiconductors, we see some de-risking in high flyers, recent high flyers. Names such as McDonald's, which went back to the highs, we see de-risking of that. Home Depot caught a bid since last year, the last 2 months of last year. So we see some de-risking here for this week. But that's all about the themes that we can extract here. If we look at the ETFs, perhaps we can see a clearer picture here. You see that we have no major move in the bond market, at least according to the TLT. It's down a bit for the week, but not much. So we see that yield-sensitive ETFs, they all did whatever their earnings showed. When we talk about yield-sensitive, of course, we're talking about the XLP for staples, XLU utilities, IYR real estate, XHB and ITB for construction and home builders, XRT retail, XBI biotech, and KRE regional banks. But again, the theme here is energy, XLE, XOP on top. USO, of course, my preferred exposure at this point right now. And the Chinese equities rebounding, FXI up about 4.25%. Thank you to the rumors of China stimulus. The outperformance go to small caps, the IWM. We have seen the TLT moving a bit higher in the beginning of the week. That's where the majority of gains for the IWM came from. And then we saw the IWM having a hard time rallying for the remainder of the week because the TLT went down. TLT is the proxy of bond prices. So it goes down, it means the yields are coming back up. Let's show you that in the charts analysis. We begin with SPY. The S&P 500, an hourly chart. What do we see here? We can't really read too much into it, folks. We have a positive trend line. If you look at the chart, then look at the RSI on the hourly. We have a negative trend line. Usually that says that we're going to break the positive trend line on the chart and go down. I don't want to read too much into it, folks. We have support at 485.22. If we break that, we have another support at 482.72. Then I don't even have to draw this for you. If we get a rebound from 482.72, we could be forming a topping head and shoulder, but again, one step at a time. All what we see right now is a sign of weakness, but we do have support at 485.22. If we look at the daily chart for the SPY, again, we see some signs of the action being toppy and ready to go down. You can see that the RSI is elevated. You can see that we have probably a rising wedge pattern that is breaking down at this point, not decisively so. So all we have looking at the chart right now is signs that we're running out of gas, but no definitive confirmations that we're reversing course right now. You look at the weekly chart, it looks more positive than the daily. It looks as, okay, we're breaking out here. Maybe we go all the way to the top of the Bollinger Bands. Problem is the RSI is really overbought here. And last time we got this reading, we got a pullback. So we are still at the risk of a pullback, but the chart still closing to the upside for the week. That's bullish, not bearish. If you want to have any bearish outlook right now, you can draw a trend line of resistance right here and say that we stopped at the trend line. And now this upcoming week, as we see the CTA is dumping, we form a reversal candle. We don't have it yet. These are all assumptions, folks, awaiting confirmations. If we look at the E-mini futures daily chart, again, the assumption is maybe we have a topping rising wedge pattern, but have we broken below? Have we lost 4,900? No. So we can't say that we have a confirmation that we are reversing course or at least pulling back here. The reversal, of course, in my book would be losing at least 4,772, closing below that for the day, and then ultimately losing 4,700. So we're still far from that happening. But if we look at the Qs, weaker than the SPY. If we look at the hourly chart, we have a downward channel for now. We're at the lows on Friday's session. We have resistance at 424.73. We have support. If we lose the channel here, we have support at 421.33. But after that, if we lose that line, you can look between, let's say, 413 and 421.33. We don't have a lot of support there, so it could be a flush down operation. If we look at the daily chart for the Qs, again, we have a little bit of pullbacks here, but no definitive signs that we are reversing course. Of course, you can look at the elevated RSI, you can look at the resistance line that we have and make up a conclusion that we are reversing course, and the next stop will be in or around the 20 days moving average. But you need to see more here. You need to go back to the hourly chart and lose at least 421.33 as support, and then we can talk about a reversal of course here. If you look at the weekly chart, doji candle, Perhaps a possible topping candle. I would say the confirmation looking at the RSI. This is the weekly RSI. We do have a positive divergence. If that's lost, and if we close the week that way, then we probably have a topping candle this week, and then this upcoming week we form a confirmation candle. And then down we go to retest the lows of the year, and after that, retesting the 20 weeks moving average, but one step at a time. If we look at the NASDAQ futures, weekly chart, what do we see here? More of a definitive topping candle than the doji and the Qs. This one is weaker. But again, do we have a confirmation, folks? We don't have it. And we had confirmation before. So you need two confirmations. You need to be as conservative as you can before you have a degree of comfort that we are reversing course here. If we get rid of the Bollinger Bands, the moving averages, and plug our support and resistance lines here, you can see that again, topping candle at the top of the rising channel this time around. The assumption is even if we pull back, we go back to the lower end of the channel. That could be in or around 16,767.5, but we have no reversal pattern until we lose 1,600 as support. You look at the daily chart this time around again. You see that the top of the channel held here as support. Got a peak above, but couldn't close above by the end of the week. The RSI is now losing steam in the daily chart. I'd love to see at least a loss of 17,210 as support. Then we can take it down to 16,767.5. If we lose that, then we can aim for the lows at around, let's say, 16,500. And after that, 16,000 even. So it's a one step at a time, one pullback at a time process. If we lose 16,000, then okay, the chart is now reversing. It's done with the optimism of rate cuts, but we're not there yet. Now, can we trade higher from here, Maverick? Sure, we can. We can pull back Monday, Tuesday, then earnings come out and we pop higher again. So the risk remains to the upside, awaiting more confirmation before we take more exposure to the downside. But look at the IWM daily chart. For now, we can argue that this is a inverse head and shoulder positive pattern. Problem is if we lose 196, and we kind of lost it on Friday, just a tick. So the confirmation line would be losing 193. If we lose 193, then the outlook changes. So we look at the weekly chart, a little bit of a weaker close here at the end. And we could argue for an inverse ABC pattern. Failure this week to rally, and a confirmation this upcoming week, forming the C leg, and down we go to the 20 weeks moving average. It's only going to happen, folks, if bond yields move higher this upcoming week. If we look at the dollar and hourly chart, what do we see here? We have an important support at 103.147. And this has been holding over and over and over again. Any divergence has been quickly corrected here. So if you're betting against the dollar, which basically means the market rallying higher, you got to see a definitive loss of 103.147. If you're betting for the dollar going higher and equities going down, you got to make sure that the dollar is moving away from 103.147 to the northern destination. Meaning, okay, we retested that level over and over and over again. I'm safe to say that this is good support, higher I go. What supports that? You look at the daily chart, 103.147, important support to keep. An important resistance to break for dollar bulls, equities bears, is if we see the 200 days moving average, as you can see in blue here, being broken. We see all of that energy from the consolidation being released to the upside. That could happen this week as we get the Fed commentary about rate cuts in March. Now, the other bullish outlook for the dollar, if we clean up the chart a little bit here, we can argue that we have, you see the inverse head and shoulder, but we have the Christopher Nolan pattern, which is the inverse head and shoulder within a larger inverse head and shoulder. So for now, I'm still on the side of the dollar looking bullish, which if the energy is released, that's going to be bad for equities. And of course, bad for the old man gold. Daily chart, what do we see here? Not holding the 20 days moving average. It retested it over and over again as resistance couldn't make it. So now the bear flag pattern persists. If we see the dollar in a breakout out of the consolidation range, we're going to see a breakdown in the old man this week. And that, by the way, means that also silver will go down. We have mixed signals here. If you look at the MACD, the momentum is changing from bearish to bullish, but we're still below the 20 days moving average. We're having a hard time here finding the energy to pop higher above the 20. No wonder why when you look at the Vortex indicator, it is a battlefield. The red line is now beating the blue line just by a tick here, which shows that the bearish momentum is predominant, but not by much to be definitive. We can go back and forth here, so we have no clarity in the chart of silver until we have clarity in the chart of the dollar. And folks, just a tip here. You can see from the majority of charts that we covered so far, we don't have a clear break one way or the other. It could go either way. And you're better off trading charts that are already breaking one way or the other and following that momentum. We don't have that in the majority of charts right now. Here's a chart that's probably breaking out in the bullish direction. UK oil, Brent oil. It is moving higher, and my assumption is after the news that we got today, it'll move even higher. But are we about to get a little overbought here? I would say if we get the 85 from Brent, that will be a point where we see the RSI really overbought. We will probably see some sellers showing up at around the 85 territory. With that being said, it's going to be a dip that will be bought after the overbought conditions are fixed. Look at the weekly chart here for UK oil. Again, the momentum is turning bullish. You look at the MACD, we have a reversal in momentum coming. You look at the RSI perking back up. We have the obstacle of the 20 weeks moving average at 83.44. We close above that by the end of the week. Then we're going back, and we're probably going to retest the highs for 23. What is that going to do to rate cut expectations? Not good. So you look at the 10-year yield daily chart. What do we see here? Holding on to the 200 days moving averages support, as you can see in blue. Waiting and waiting for another piece of data for all of that energy to be released. Of course, the bet right now is we're going to see a release to the upside. The market bulls are betting for a release to the downside, because if we see a drop in bond yields, that's going to support equities going higher. No doubt about it. But for now, I think that we've thrown a lot of stuff on the dollar and bond yields to go down in the last couple of weeks. They didn't. They've been holding out to the 200 days moving average as support in the case of the 10-year and as resistance in the case of the dollar. So if all of that energy is released because we have a tailwind, be it the jobs report, be it the Fed commentary, then that's going to be bad for equities if the dollar and yields break to the upside. And the ETFs at most jeopardy here, the yield-sensitive ETFs such as the XHP Home Builders, which has been resilient and defying any moves higher in bond yields because of the strength of home builders. But this week we got D.R. Horton, and that guidance was not good. That report was not good. Doesn't justify the stock trading at all-time highs. So D.R. Horton went down. It could be the beginning of the break here in the XHB, but we need as many confirmations as we can. Now we can argue if bond yields go higher, we have an inverse ABC pattern, but the confirmation would be losing 91.45 as support. IYR, real estate, weaker than the home builders. Now flirting with the blue line. This time around, it's not the 200, it's the 50 days moving average. You see yields going higher and real estate breaking below the 50 again. That would be a shorting signal here. And then we look at the KRE regional banks, also yield sensitive, but this one is trading higher, above the 20, above 51.38. We can argue that maybe we have a bullish pattern of an inverse head and shoulder, and higher we go. You look at the MACD, maybe we have a change in momentum from bearish to bullish. But the argument that goes against a rally in the KREs, if we plug in TLT, bond prices, we have a divergence here. KRE going higher, but bonds are going down. Can the KRE continue to defy the bond market here, meaning bond yields go higher and the KRE says, yes, that's good for me? I doubt it. I think all of these divergences will be fixed here. If the TLT keeps going down, I think the KRE will have to snap and give up and go down with it. The VIX 4 hours chart, what do we see here? We talked about the head and shoulder last week. We got a massive break to the downside. We broke below the gap, and then came the demand for hedging in the middle of the week. We made it above the neckline, as you can see in yellow, from the previous head and shoulder pattern, but then we closed below on Friday's session. What do we do here? We can argue that we have an inverse head and shoulder. But again, the ultimate confirmation, folks, is we need to break above 14.13 and keep that as support. Then break above 15 before we see the VIX moving higher and equities giving us a clear reversal signal. TLT, since a lot of you owning the TLT since last year, rightfully so, but we have support of the Fibonacci here at 93.64. If we lose that, we can make an argument here that we have a topping head and shoulder, and if we lose that, that means the yields are going higher, and I think at that point, IWM will go down, XHB will go down, IYR will go down, even the KRE could give up and go down. Now, the big guys, the SPY and the Qs, they depend on the big guys and the chips. So we look at the biggest one of them all, Apple hourly chart. We talked about this pattern here in taking the short trade against Apple. We talked about the loss of 193.83. We talked about the lower highs, lower low pattern. So we got a break on Friday. The trade is profitable. Now we're forming a bear flag pattern. We have a gap fill at 191.73. If we lose that, then we have more losses to come. But I would say I'm going to close the trade before we get to Apple's earnings. So if we go down again Monday at 190, 189, book profits right away. Now on the daily chart, what do we see here? We do have the 50 coming up as support at 190.84. That should hold or at least give us a rebound. So that would be my point of exit here in the trade that we have issued in Discord. We have earnings coming out really soon. If we lose the 50, then we have the 20 in white. If we lose the 20, then we got a problem here. And looking at the weekly chart for Apple, we talked about the scenario of closing the gap, then coming down. And this week it appears that we have a topping candle here. What if we're forming an inverse ABC pattern? Sooner than later, we lose the 20 weeks moving average. We go down to the lower Bollinger Bands again. That's the bearish outlook, and you have to be aware of it. If you happen to have Apple in your portfolio, you need a really good hedging strategy this week. Look at what happened to the Souffle Tesla daily chart. The first observation is the RSI is really oversold. Second observation, we're outside of the Bollinger Bands. Third observation, we have a bearish cross here with the 20 days moving average in white crossing below the 200 days moving average in blue. What do we do with this outlook here? The oversold conditions, and following up in the conversation that we had in the options market coverage, suggest that we have a rebound coming in Tesla. But once the rebound is over, we're going to resume the downside momentum. And if you look at the weekly chart, we do have support at the lower end of the channel here in yellow. We have support at 193.91. So again, any rebound in the short run here, it could be short-lived, and down we go again in Tesla until the weekly chart becomes really oversold. Then we can talk about a more reliable bounce. Nvidia, what do we see here? This is the hot. This is what's keeping the SPY and the Qs going higher. If these guys go down, then we got a problem. And right now, is it too hot? That's the case. The answer is absolutely yes. Look at the RSI. It's out of whack. Problem is, do we have a reversal pattern? The answer is no. We haven't closed below the lows of 2 candles. We're looking for 2, not 1, because we want as many confirmations as we can. So we don't have that confirmation yet. We might have it this week. AMD might come out with a weak guidance. It goes down, dragging NVIDIA down with it. Then you look at the weekly chart. Out of whack, outside of the Bollinger Bands from a weekly standpoint. But we can resolve that, ladies and gentlemen, by consolidating for a few weeks. So again, you need as many confirmations as you can before you take that short trade on a pullback for NVIDIA. On the daily, I would say you got to at least lose the lows of 2 candles, not 1. So you got to lose the low of Thursday. And then on the weekly, you got to go below the upper Bollinger Bands right now. And to make it easy here, we can take the low of the week, which is 585.85. We lose that. Then we can unlock more downside in the correction here in NVIDIA. AMD, 30 minutes chart. It appears that we're running out of gas. We have a topping head and shoulder with support at 176.5. We lose that. Head and shoulder plays out. Next support is the gap at around 168. After that, we have the previous high at 164.46 on the daily chart. Looks weaker than AMD. But again, folks, if we get another drop out of it Monday into Tuesday, I'm going to close my put options trade. I will leave it to earnings. If the guidance comes out bad, then no doubt in my mind the stock will go down. If the guidance come out saying, you watch out, NVIDIA, we're going to take away some of your business here, then AMD pops big, NVIDIA goes down. We could see the divergence here, folks, where AMD and NVIDIA trade in different directions. Tulips, Bitcoin, what do we see here? On the daily chart, we're keeping 40,000. That's the good news. Bad news, at least at the time of the recording of this video, we're not finding the energy to crack above the 20 days moving average. If we do, then we can talk about, okay, higher we go to the upper Bollinger Bands again. If we lose that 20 days and we can't make it above, then we lose 40,000, confirmation for more downside to come. Okay, let's move on to the conclusion of this video here, folks, and see what we got on the economic calendar for the week. Monday, tomorrow, 29th, we got nothing. So the macro will not be front and center. I think the geopolitics will be. I think that speculation about the Fed policy will be. The de-risking in chips will be. And then comes Tuesday, Jan 30, we have the Case-Shiller Home Price Index, and we have job openings and consumer confidence, all important. Wednesday, the 31st, last day of the month, we have the ADP report for the private sector of the economy. The Employment Cost Index, an important indicator for inflation in the economy and the prospects of reinflation. Then we have the Chicago Business Barometer. On top, of course, the big day, the big decision here, which we know nothing. Decision is nothing. Keep it as it is. What about the commentary, though, for the March meeting? Then Thursday, the first day of February, we have initial jobless claims on top of U.S. productivity, final readings in the manufacturing PMI, and we get ISM manufacturing for January. And lastly, Friday, February 2nd, we have the big day again, the payrolls, what comes with it, the unemployment rate, hourly wages, on top of factory orders. Another important reading, I would say, the final reading of consumer sentiment. Because a lot of fuss has been made about the initial reading of consumer sentiment. Oh, folks are feeling better about the economy right now. Let's see what the final reading looks like and then jerk off to it. And of course, a reminder on the earnings calendar, we have plenty. Monday, we have SoFi and Whirlpool. Tuesday, we have Pfizer, GM, UPS, then Microsoft, AMD, Alphabet, and Starbucks after the bell. Wednesday in the morning, we have Boeing, and after the bell, we have Qualcomm and MasterCard. Thursday in the morning, we have Merck, and in the afternoon, we have Meta and Apple. Friday, we got Exxon, Chevron, on top of AbbVie, Regeneron, and Cigna. Are we that, folks? That's all I got for you for now. If you enjoyed the show, you know the deal. Press the like button, subscribe, consider becoming a member. We do a lot for the members. Consider joining here, see how you like it. But folks, for now, this is all I got for you. So thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
My work here is finished. See y'all on the dark side of the moon.